Just a minute now.
Okay. So I again repeat. So I again just repeat once. So this is a 4 different scenarios under which we are going to calculate. Okay. And when you are talking about likelihood or chance, it is the probability calculation. So here we are assuming that 4 of these scenario have a equal chance of occurrence. Your probability summation is always 1. And 1 means you are 100%. So here we assume that each scenario has a 25% chance of occurrence. So your expected return is the product of your return into probability, and then you take the summation of that. So this is what you're doing. Your expected rate of return means every year return into the probability. Say scenario 1, probability is 25%. So what is the return of scenario 1? You'll calculate. You know how to calculate the rate of return. Then you take the multiply it with the probability. For each of this scenario, you take the summation, and that is your expected return. See, this is your expected return. Your R1 into your P1, and this goes on for all the years. Have you written till here?
Yes, ma'am.
Okay, so let us proceed. So let's solve. So let us, for that, you go to your hands-on session number 3. You go to hands-on session number 3. Okay. Can you see this Excel sheet?
Yes, ma'am.
I think I have to share this one. Can you see
Yes, ma'am.
what you are saying? The same question. 305, 285, 261. Then the dividend values are there, which is 4, 3.25. Then can you see dividend yield here?
Yes, ma'am.
How much is the dividend yield? Is dividend yield given here?
No, ma'am.
No. So how to calculate the dividend yield? It is your dividend per share. How much? Your dividend per share, which is your how much? Share. Okay.
Yes, ma'am.
Divided
Into
by
shares.
what is the share price? 261.25. Check it out if it is correct.
Yes, ma'am.
261.25. No. So this is
Yes.
what it is. Simply divide, get it. You can reduce the number of decimals. Okay. So similarly, for second one, same way you do. So this dividend divided by your share prices, 261.25. Similarly, this for go on dividing with the share price. This is your dividend yield. So your dividend yield formula is dividend per share into the share prices. Small calculation, you rather do in calculators or Excel, whatever you have, so that you just know how to do. Short time you have to do so much calculations. So once you are handy, these are very easy. So then capital gain. What is the capital gain formula? It is your present share price, which is your, let us put a bracket here. So this is your 305.5 minus 261.25 whole divided by 261.25. This is your capital gain yield. Same you do for all the other scenarios. And lessen the decimal. This is equal to, put a bracket. So this is 285.5 minus same 261.25. Close your bracket, divided it with 261.25. Your answer. This is your, same for the 4 scenarios, you go on calculating. So for this, oh, your price is here. Stagnation gives you the actual price. So this is 261.25. Last one is put a bracket and then minus 261.25 all divided by 261.25. Okay, so you can reduce the decimal. And then what you do is I've written the steps, you can see. So now what is your average, not average, your rate of return for every scenario? Your rate of return is simply you take the summation of 4 and 5 because it is the summation of your dividend yield plus your capital gain yield. Simply you do 4 plus 5, column 4 plus column 5, and simply drag it. Can you see?
Yes, ma'am.
You change it into percentage. That means you take this value, multiply it with 100. So it is changed into your percentage. First one is 18%. You just drag it, you get your percentage. So the highest return is in which year? Variation is between what range? Highest return is during the high growth
High
scenario,
growth.
18%. And the maximum decline you can go is minus 6%. So it is varying to this level. Okay. So now we are going to calculate the expected rate of return. Whenever probability is there, means you are going to calculate the expected rate of return. Till then, you already knew the how to calculate. You calculated the rate of return every year. Now we are going to change it into expected rate of return. Okay, till this column, you already know how to do. So now from this, what you are going to do is for expected return, what is the procedure? Simply you multiply it with the probabilities. So here our assumption is every scenario has an equal chance of occurrence. That means you simply multiply the return with their probabilities. So it is your 18.469 into your probability is 0.25. Enter, drag it to get the value for each year. Got it?
Yes, ma'am.
Then calculate the expected rate of return. Expected rate of return is how much?
Um, 0.139, 0.079.
Yes, how much is the thing? How you are calculating? Simply you take the average of that. Okay. How much you got? 5.9. Simply take the summation. Summation of the expected return.
Ma'am, we have to multiply with the, for expected return, we have to multiply with the probability.
Probability, yes, 18.469.
And then multiply with it with 100.
Yes, just to convert it into percentage. You can work with decimal also, but why should we? You just
Yes, ma'am.
multiply with 100, so as to change it into percentage. Otherwise, you have to work with all decimals. Everything will come into 0 point something. So you get this answer, which is the this is your expected return, EPR. Got 5.96
Yes, ma'am.
around. Okay. Now simply you know the same methods. Now your whatever you have calculated, you are calculating the risk involved under this scenario. That means you are calculating the variance and the standard deviation. So your procedure is same. Only thing is here probability has been added up. So standard deviation you are calculating. So here what you are doing? Simply go on subtracting. I have written the steps. That's why. Your next, this is your R you calculated. So this is the column of R you calculated, the expected return. Then take the difference. This is your here R. Remember here. Can you see the return 18.469? Okay, now your expected return is 5.98. So just subtract. So this is your 18.469 minus your value is 5.981. Enter. So this is second one is 10 point something, and directly click minus this is your 5.981. This is your return next year 5.981. This is your click on the return minus 5.981. Enter. Then square it. Same procedure. Just square the returns. So raise it to the power 2. And then what you do is simply multiply it with the probabilities. Each square, same formula. Each square into its probability. Its probability is 0.25. Enter. Drag it. So if you calculate the variance now, variance is the summation of this equal to just take the sum. And what is your standard deviation? Square root of this. Equal to square root. 10 to square root. Let me know if you have got these two answers or not. If not, proceed and complete. Don't be wherever you are not getting, you just tell me. So after you got the expected return, okay. After you got this expected return, which is your expected return, which is your rate of return. Okay. Rate of return in percentage into probabilities. You got the sum, which is your expected return, which is your 5.981. I'm just making it red. You'll understand. Then for the ninth column, what you have done is your return in percentage. I'm just changing the color so that you will understand. So return in percentage is here. That subtracted with this 5.981 every time. Because you have I've written the, if you just click, you can see it is written there also, the formula. R minus expected return. So your return is your return in percentage minus the expected return. Same formula, no? You have done it for single asset, variance and standard deviation. Same formula. Then you are squaring this. Next column you have squared this. Then here extra step is now you have the probabilities. So you have to calculate this step. After squaring it, you have to multiply it with the probabilities. Because you have done that R1 into your probabilities, and then you're taking the sum square, and then you're taking the sum. You just wrote the formulas now. Did you get these answers?
Yes, ma'am.
You got this. Variance is 86 and standard deviation is 9.
Yes, ma'am.
Good. Let us go back. So this is session. Which number was this? Third.
Yes, ma'am. It was.
See from here. Can you see the PPT? No?
Yes, ma'am.
Okay. So the total return is, you already saw, it is changing bit from 18.5 for the growth years to -6. Now, what is the step to calculate the variance and deviation? Already I showed you. You calculate the return in percentage. You have done. Multiply it with the probabilities. Take the deviation from the expected return. Square the deviation. Multiply it with the probabilities and standard deviation. You know the square root of the variance. Already you did just now. This is what is measuring the average dispersion. That means how much your return is varying from your average value. So if you have your standard deviation as 9, so the risk is if there will be a 9% up and down both sides. It is plus minus 9. So whatever your average rate of return, how much is the average? 5.98. So your the deviation can be plus your standard deviation minus your standard deviation from your average return for these assets. Okay, and for any calculating the risk, higher the standard deviation, more the risk. lower the standard deviation, less the risk. So if you are seeing where to invest, you can choose anything depending on the risk factor, depending on the return factor, depending upon what type of investor you are. So that will affect your decisions. Okay? So this is another calculation you do by yourself. Okay. So risk preference. Now you see the risk preference. The information about expected return on standard deviation help us to make decision about the investment to do or not. Okay. So this depends upon what type of investor you are. What is your risk preference? So depending on risk preference, you can be a risk seeker. You need more risk. Okay. And you may be risk neutral. You don't care about the risk. You just see the return. You don't know what is the risk. You are not interested. You just see the return. Or you may be risk averse. Means you avoid the risk. Whatever the return may be, you don't want the risk. So depending upon the risk factor, it is divided into three. One is risk taker who want more risk for higher return. Risk neutral who don't care about the risk. They simply see the return. Okay. And risk averse is who don't want risk, whatever the return may be. So coming to this, so according to here, risk averse investor is one who will choose investment with equal rate of returns. Okay, equal rate of return, the investment with the lowest standard deviation. Lowest standard deviation means, remember, less risk, less variation. Okay, so he will always prefer the investment where the return, whatever it may be, risk is low. He is a risk averse investor. You need not write, I'll send this PPT, but you note down that you have to note it down. We'll get questions on this. Understanding, Yashasha and Nikhil?
Yes, ma'am.
Yes, ma'am.
Risk averse investor. You'll get theory question on this. Let me tell you, you're attending the club. So risk averse investors is this is the definition. So they want to avoid the risk. So what they will see where the standard deviation is low. They'll choose that type of investment. And how to calculate the standard deviation for different asset, I've sent you hands-on session. I showed you with the stock market. You can do it for your treasury bills and all, and compare the result. Answer will be in the PPT. I'll send you. You must have seen here also this video I'll send. Then risk neutral means whatever the risk he is not carrying, he only wants to prefer the investment returns. Higher returns, whatever the risk, he is ready to dive into. Okay, and risk seeking investor means they want to take more risks so that the return will be high. If you are investing in that stock market, HUL, I showed you huge variability in return, but you can see the return is also highest there. So if you assume and the market in fact prospers, in that case, your return will be much more and compensate for whatever risk and losses you have incurred. Okay, so this is three type of investors. Seeing the type of investor, everyone don't go for low risk or everyone don't go for high risk. It depends upon what type of investors you are. Okay, so better to always diversify your portfolio. We as investor, we never put our money only on stock or only on FDs. In that case, you will not know. Suppose you are putting all your money in your FDs. In that case, you never see the growth. No, whatever the return, you know from day one what interest you are going to get. Similarly for bond, from day one, you know this is the principal and amount I'm going to get. If the market is prospering, you will not get a share in that. If you are putting all your money in your equities, you always are very tense because you have assumed all the risk. Anytime the market fails, all your investment goes. So you cannot do that. What you can do, you have to create a portfolio where you diversify your money into different saving schemes, investment schemes, and you will always see that your return will be optimized. And this is what we are going to do next. We'll take a portfolio. So this what we did today is calculating the risk and return for a single asset, a group of asset. Now we are going to create a portfolio of this because you as investor should never invest in a single asset because in any case it fails, all your money goes. So as a prompt investor, we always work on portfolios. You as an investor, you must have invested on your recurring, on your FDs, on your stock market, or some PPFs and all. That means what we have done is we have diversified our portfolio. Even if there's loss in one side, the gain from the other will compensate.
For example, if there is a crisis, the equity may not perform, but your bond investment in bond will give you the security. If the market is prospering, your bond is not working, it will not grow, but your equity is giving you the return. So when one will fail, other will go up. And that's why we create a portfolio. Understood till here?
Yes, ma'am.
And we'll stop here today.
Okay, ma'am.
Okay. One minute.